Good afternoon. This is Matt Harris from Hightower's OCIO department. We're excited to bring you the post-election webinar today. 2020 has been a year full of ups and downs in stock markets, economic data, with individuals' emotions. And while it may seem cliche at this point, 2020 and the word unprecedented seems synonymous at this point. This election has been no different, and here are a few stats to highlight how unique this past election season has been. In 7 of the last 8 federal elections since the financial crisis, the United States has removed the party in power in 7 of 8 of those elections, the most in any 8-year period over the last 100 years. Also, if Vice President Biden does in fact win the Electoral College vote, we have not had a Democrat president elected with a Republican Senate and a Democratic House since 1884. So well over 130 years. So with all this in mind, this webinar is here to provide you with our updated view, as well as some experts out there from various partners that we work with to give our take on what to expect going forward. Stephanie Link, Chief Investment Strategist at Hightower, is joining us, as is Nicholas Millikan, Managing Director at CAIS IQ. And last but not least, Jillien Flores, a Managing Director from Vanguard's Government Relations Department. Before we get things going, 2 quick housekeeping items. First, this is being recorded, so if you miss part of it, we'll be able to show it to you again at a later date. And then second, we will be taking Q&A during the entire webinar. At the bottom of your Zoom panel, you should be able to see the Q&A button. So please submit questions to that, and we'll be answering them live. Let's get to it. And I'll start with you, Jillien, to give us some background and kind of set the stage on what's happened, because there's been a lot of different elections. There's some items that are still outstanding. Can you give us a quick recap of the elections, both or all 3, the presidential, Senate, and House? Where do we stand today?
Thanks, Matt, and thanks for having me here today. I think that's a great way to kick off today's discussion that's really in the context of what we've experienced in the past week, and really also, maybe more importantly, what's ahead and what does it mean. So as we all know, Biden has been declared, for all intents and purposes, the president-elect, and we do anticipate he will take office on January 20th. In the meantime, there are some House races that are still yet to be decided, but it is largely known that Democrats will maintain control of the House. And in the Senate, there are 2 Georgia seats that are going to a runoff on January 5th. And that might be the key here to much of our discussion today, because the outcome of the Georgia Senate races ultimately can determine whether a President Biden is dealing with a divided government or a unified government. If both of those races fall into Democratic control, which some might say is unlikely, we can maybe get to more of that in the conversation today, it would give Biden the ability to really fully advance an agenda. Looking back to the House outcomes, even though it's not completely resolved at this point, I do think that most onlookers are maybe surprised the Democrats did not pick up additional seats, but instead did lose some, which tightens their majority in the House and will probably have some implications for the Biden administration and how progressive an agenda he may be pushing.
Perfect. And I think one question that is on everybody's minds is, what is the likelihood of anything changing between now and Inauguration Day? As you mentioned, Biden has been identified as the likely president-elect, but we know President Trump is contesting these election results in many states. What's the likelihood that anything changes?
Yeah, I think it's hard to see a pathway that results in a different outcome other than Biden being sworn in as president early next year. I think the remaining questions are really about what this interim period looks like and the degree of uncertainty and potentially unrest that could build up if the president is unwilling to, acknowledge the outcome of the election. So that remains to be seen. Another dynamic, I think that it's a play that might be more meaningful than whether or not Biden will be president, because we do think he will be, is really Biden's ability to set up a robust transition team and transition period, because he is not yet being given the tools that typically a president-elect is given to really hit the ground running. You know, the budget, the emails, the access to the buildings, that will impact his ability to really be ready on day one to, advance a slate of nominees to key cabinet positions and to really be ready to roll out an agenda right off the bat.
Perfect. And we will touch on some of that in a little bit, because I think some of that volatility that we could see or may not, may be a topic we'll touch on in a little bit. Let me turn this to markets in a way. Nick, the president, again, has been on a clear path, and Republican leadership has been behind him on starting to contest these elections. What do you think the volatility that we were just alluding to, how could that play into markets? What's the timeline for that to really start impacting markets on the contest of the election results?
So that's a really great question, Matt, and thanks to everyone for having us involved today. It's a pleasure to be here. So, on volatility in markets, obviously markets hate uncertainty, and certainly as we ran into the election, the uncertainty around who was going to get the nomination and the nod from the electorate dissipated, and we saw that rally in equities, which I think is reflective of the fact that this contested House is actually a good outcome for the markets, and we can talk about that later. But contesting the election result from here on out in terms of President Trump and the Republican Party, I think markets, and you saw this yesterday, you saw markets spike precipitously there based on the news and based on the news of a vaccine. I think there are things that people are looking at and through past, the election, so the inauguration in January of next year. So if we think about the impacts of a vaccine, this is going to be a 12 to 18 month story, but markets are already focused on its potential to turn around the recovery in the economy. So, I think, in my opinion, it's largely discounted by the markets. Having said that, if there is a flip in any of the states, which is probably unlikely, and Jillien can certainly talk to that, I'm sure. If that was the case, then I would think you would see markets increase in volatility, almost instantly on those sort of news. But I don't think we're in the same jittery place as we were when there was so much uncertainty, not only around the virus, but around the election itself, as we saw back in March and April and May of this year.
Yeah, the last couple of weeks is not short on news, at least positive news for markets. Let me turn to Stephanie. Stephanie, we over the last couple of months, frankly, we've been talking about the benefit of a divided government and how that's actually historically been good for markets. Can you talk a little bit about why that is and how you're seeing markets play out with a divided government?
Sure, and I'm delighted to be here with Jillien and Nick, yourself. This is great. Look, the markets, as Nick just mentioned, they do not like uncertainty. They like certainty. They like gridlock because they don't want any surprises. They don't want any drama. And in this case, they certainly, I don't think, wanted huge tax increases and the blue wave from an investor point of view, right? So because we have kind of calculated these numbers, if all of the tax increases that Biden and his team have talked about, that would probably impact corporate profits by 8 to 10%. I have no doubt that companies would be able to deal with it. They would just cost cut, probably make more layoffs, which is unfortunate in this time, but they'd be able to deal with it. But the fact of the matter is gridlock is pretty good for the markets overall because nothing really gets done. Maybe on the margin, some things get done. And in this case, even though McConnell is on tape this afternoon, just about 10 minutes ago, saying that there needs to be more in terms of progress on the fiscal, they do both agree fiscal needs to happen. You can't have 9 million people unemployed. You can't have small, medium businesses go out of business every day. And you can't have schools and education really be compromised without having more help. So I do think it's going to come. It's a matter of time. It's a matter of the dollar amount that's going to be negotiated, but it is going to come. And that is also a very big positive. But I want to go back and just simply say, and I have quoted the Capital Group many times, but it's really very, very important. Elections in the near term create volatility, no doubt about it. A lot of questions, a lot of uncertainty, I get that. But longer term, it really doesn't matter. So Capital Group did this piece, and they said, look at the S&P 500 composite index over the last 8 decades. In 18 of the 19 presidential elections, a hypothetical $10,000 investment made at the beginning of each election year would have gained value 10 years later, regardless what party was in, what candidate won. In those 15 years, in those 15 over the 10-year periods, a $10,000 investment would have doubled. So my point is, longer term, let's look through this and think long term as investors, which is what we do, especially at Hightower. So short term, we take advantage of the uncertainties and the market gyrations. And we look at for opportunities because we do believe in the long term. I do believe very strongly that the fiscal stimulus and the monetary policies put in place will lead to better growth in the economy, which will lead to better profits. And as I've said many times, stocks follow profits on the up and on the down, but they're headed on the up at this point.
Yeah, everybody always appreciates it when it's on the up, but it's on the down as well. I think we'll pivot from the divided government back to the Georgia Senate race, because a lot of what we've been talking about both today and then what we've seen in the news, there's a large assumption that the 2 seats that are up for the special Senate race are actually going to go to the Republicans. Jillien, what are you seeing and what are you hearing about these specific races? Because I believe, and you're the expert here, there's 4 candidates in total. This seems a little bit more uncertain to me than it may be to you, but can you give us some background on what to expect on January 5th?
Absolutely. And I'll start by saying that I think it's conventional wisdom that Republicans have the upper hand in these runoff races. So just to set that aside, I also want to talk a little bit about why it may not be as straightforward as it usually is. There are a lot of dynamics this year that are just frankly different for some obvious and maybe some less obvious reasons. So there are 2 races for US Senate, which usually doesn't happen, as you know. They are usually on different years per state, but because Senator Loeffler was named to fill the remaining term for Senator Isaacson, who stepped down a few years ago, he had to actually run for the first time rather, this election, which was at the same time as Senator Perdue looking in a conventional way to another 6-year term. So Loeffler has never been elected. So even though she's an incumbent, it's a little bit different than a conventional incumbent like Senator Perdue. So I would say if really comparing the 2, he seems to have the upper hand in terms of name recognition and general support. Loeffler's challenger also is a very qualified challenger who is doing really well in his own right, Dr. Warnock. So it will be interesting to see where the votes come down when it is just the 2 of them to get a 50% majority rather than it being a 3-part race or in their case, many more. So I think more to come, but typically in Georgia, especially in runoffs, it favors the Republican, whether it's an incumbent or a challenger. Georgia is changing. And also this election is different. Voter turnout is typically really hard to energize for a runoff because, without a top of the ticket excitement, a lot of folks just let it slide by and don't really engage. This is different because I think we all know what's on the line, and whether you want the Senate to be in Democratic control or in Republican control, if you are a Georgia voter, you suddenly feel like your voice matters, maybe like it never has before. So the money that will be poured into the state from all over the country for both parties to energize the voters that just came out in record numbers a week ago to come back out and vote, and whether that's a mail-in ballot, they probably, many of them did not appreciate the ease in which they could request a mail-in ballot. The education behind the general election has made it much more accessible and understandable. So I think we're in for a much greater turnout than we've ever seen for runoff races. I will say that little historical trivia, the double barrel races, as it's known, where there are 2 Senate seats running for re-election or election at the same time, that's happened about 55 times, I believe, in our history, and only 8 of those ended up being split party. So conventional wisdom would say that, if Purdue does well, probably Loeffler will as well, because most folks that come to vote will be really coming on behalf of the Republican ideology or their Democratic ideology and voting accordingly rather than splitting that up.
Got it. And this might be getting a little bit too far in the weeds, but I believe the view is right now with those Republican votes, if those went Democratic, it would be 48 Democrats, 50 Republicans, and 2 independents. I think everybody is assuming those independents, if that occurred at the 50-50, they would lean Democrat. Is that safe to say?
Yeah, that's a great point, Matt. And maybe I skimmed over that a little too much. I think we tend to throw those independents into the bucket of Democrats that are currently already elected or reelected, when you're right, they really have the ability to approach that however they want. That said, it would be very surprising if those 2 independents did not continue to caucus with the Democrats, which in the event that Democrats won both Georgia seats, it would be, as you said, 50-50 if you include those independents among the Democrats. And of course, then the Vice President-elect Kamala Harris would be able to cast that deciding vote. And we would anticipate she would be very willing to, push ahead with a progressive agenda if that was the wishes of the Biden administration and of both chambers of Congress.
Perfect. That's helpful detail. Now, Stephanie, I'll turn back to you, because again, the expectation is a Republican wins in Georgia for the special Senate runoff. If in fact it goes the other way and it is then a blue wave, what do you expect to see in markets now that it is no longer a divided government? Does the vaccine news and good corporate earnings offset this potential delayed blue wave? How do you see that playing out?
I think the markets probably would initially sell off just on the uncertainties about what kind of tax policies can be put in place and enacted, but it does certainly seem more likely in a blue wave that taxes go higher. I don't know how much they can do in a COVID world until we get a vaccine, until it actually is implemented, which doesn't seem like it's anytime soon. So for the short term, I think the markets would certainly sell off. I think longer term, I do believe companies can offset these higher taxes, as I mentioned before. Certainly it'll be a hit to earnings, but companies have done a very, very good job at trying to control costs, restructure, and really right size. And they've done a masterful job this year, considering all that they were put through. And those are the companies that are beneficiaries of stay at home, and those are the companies that are not beneficiaries from stay at home. All of them have done a terrific, terrific job, and it's commendable for sure. So going forward, I think, should the market sell off on a blue wave, I do think it would be a buying opportunity. I do think that it's actually able to be controlled in terms of the tax implications. But at the same time, if you get a blue wave, you probably get a higher dollar amount in terms of the fiscal bill that gets passed, right? So there's a big divide right now between like $1 trillion and $2.5 trillion, and what's the number dollar-wise on fiscal. I think a blue wave gets you more fiscal, and that will offset. And of course, vaccine, most important, right? We got to get everybody safe. We got to have people get more confidence in getting back to normal. We're going to be wearing masks for a very, very long time, but if we can get some confidence in the system on top of the confidence we already have, because quite frankly, I'm surprised that the consumer has stayed so strong. I'm surprised that business confidence has stayed so strong, that housing and auto have actually seen remarkable V-shaped recoveries, manufacturing as well. So I think we've done a really good job as a country trying to figure out how to get around this. It's been a tragedy, of course, but we'll get through it. And I don't think it matters if it's blue wave, red wave, any wave, to be honest with you. I think US corporations can deal. And I think should the market sell off, I think it would be a buying opportunity, as I mentioned.
Got it. And again, the key point, staying invested for the long term. It's easy to, particularly in volatile times, and particularly the strong up markets like we've seen the last couple of weeks, it's easy to get caught up in that short-termism, but staying invested for the long term is always important. We'll come back to stimulus in just a few minutes, but Jillien, I do want to touch on taxes, because that is something that's been highly focused on by a lot of people for the last couple of years, frankly, with Trump cutting tax rates recently. When we look at the current state of the global economy, which to Stephanie's point has been improving, confidence isn't as bad as it used to be, there's some concern or disbelief that there will be material tax increases in the coming years. What are you seeing and hearing from all of your contacts in Washington on the outlook for tax policy, both at the corporate level, the individual level? What's your take?
Yeah, so Stephanie touched on some of this. So just to reiterate some great points that she made, I think in a divided government, major tax changes are off the table. We're really not looking at a scenario in which a Republican Senate is going to greenlight any sort of major undoing of the 2017 Tax Cuts and Jobs Act, or TCJA, or take on new initiatives like potentially a financial transactions tax, for example. On the other hand, I do think we have to acknowledge there is a chance that Democrats do take control of the Senate. So let's just talk about it as though that's the case. What does that look like? I agree with I think what Stephanie was saying, that in that environment, major tax reform really can't happen right off the bat because the focus is on COVID relief. The focus is on pouring trillions of dollars into the economy, which is just fundamentally at odds with saying, okay, now we're going to take things away, whether it's at the corporate level, the individual level, what have you. So I don't think that could happen right off the bat regardless. Some things that I think we would anticipate being nearer term priorities for the Biden administration, and his campaign's been pretty forthcoming about much of this, is he wants to restore the top individual rate to 39.6%. He wants to raise the corporate rate up to at least 28%. He wants to lower the exemption for the estate tax to make it much less easy to pass money to the next generation. I think he hasn't been enthusiastic about an FTT in the way that some of his primary opponents were and are, one being his vice president, Kamala Harris. But I think a financial transactions tax is a really interesting kind of free pot of money politically, because it could raise upwards of $800 billion to over $1 trillion potentially, and rhetorically it just beats up big bad Wall Street, which is something that I think might seem really enticing to pay for some potentially completely unrelated priority, whether it's infrastructure spending or something in the education lane. He also talked about changing fundamentally the tax incentives for retirement savings. And that's something that at Vanguard, we'll be keeping a really close eye on, really just regardless of unified or divided government, just to make sure that we can help educate any policymaker that is thinking about upping the tax deferral for retirement savings, really thinks about the unintended consequences of that.
Got it. And their taxes, the tax rate is always the headline that everybody focuses on, but some of those other nuanced areas that you just mentioned, estate tax, as well as changing the savings policies for retirement accounts. These are some of the nuances that do impact end consumers just as much as some of the tax rates that, again, are the headline numbers. Nick, how do you anticipate tax policy or tax changes or lack thereof from your viewpoint as impacting markets? Are there any sectors or industries that you think are going to be impacted more or less?
So looking at tax policy, I think, as I mentioned earlier, it was very clear as we headed closer to the election that there wasn't going to be this blue wave. And, I would argue that even with the Senate races in Georgia still left to play out, the one group that kind of called the election right were the prediction markets globally. And right now they're saying, it's a 20 to 25% chance that Democrats actually take both of those seats. So, just looking based on that, the assumption should be that, we're going to have this divided Congress here come the 21st of January. When things get back into session. So looking at the current environment, I think, rather than focus on where tax is going to be, I think you focus on, some of the things that Stephanie has talked about with, what does that mean for fiscal stimulus? Like we had, $2.5 to $3 trillion being pledged by the Democrats. We've been unable to come to terms with what that looks like from the Republican base. But, what's interesting about this and the potential difference is now we've got a result. We're looking for President Biden elect to come in January, and that may actually accelerate the next round of fiscal stimulus, whether it's $1 trillion, which that's not an insignificant amount of money. That's 5% of GDP currently. So I think there's probably the better chance that rather than anything tax related weighing on the market or buoying the market, that accelerated fiscal stimulus is exactly what we need now. You know, the CAIS Act, for the most part, rolled off in July. We had a really strong recovery until then, and we've seen the recovery in the economy kind of sputter since that time. So we really need to get fiscal stimulus, which actually gets to the heart of people and their spending. You know, the US economy is built on the consumer. It's 2/3 of the consumer. So if the consumer is in a really weak place, which I would argue that they haven't been so far, as Stephanie said, you know, one of the things that happened during the pandemic was FICO scores went up because people took that stimulus and they paid down their debt, which is great. So they delevered. But you know, at the same time, this whole pandemic, whether you're a business or a consumer, you need to be able to get through to the other side. And fiscal stimulus is the most important part of getting the consumer to the other end when the vaccine essentially kicks in. So, you know, I see that as the most important thing that will impact markets going forward based on its ability to pull forward that consumption.
And that's a perfect transition, because the next question was going to be focused on stimulus. And Stephanie, this has been a key focus of yours, even since before you got to Hightower, seeing you on CNBC and so forth. You've been focused on how much it is as a percentage of GDP, both in the US and globally. This isn't just a US phenomenon, but talk a little bit more in more detail about what you do expect the stimulus to be and when, because with the either lack of a transition team from the Trump administration to the Biden administration, that could delay things. But what are you hearing on amounts and timeline?
Yeah, so I definitely think it's going to happen, and I've been very vocal about that. I've always said, though, the timing and the dollar amount are the question marks, but it has to happen. As I mentioned before, you can't have 9 million people unemployed. You just can't. And so many parts of the economy, travel, leisure, hospitality, obviously very much all suffering now. That said, that's the negative. The positive, and why I have said for a while now, we have an uneven economy. We have parts of the economy that are doing quite well. And the parts of the economy that are doing well are 3 times the size of the travel, leisure, hospitality industry. So that, I mean, housing. We just got a 1 million SAR last month in new home sales, right? Pending home sales and existing home sales and new starts. All these numbers are up double digits year over year. So housing is doing quite well. And of course, housing is interrelated with auto. You buy a house, you got a multiplier effect. You got to put stuff in the house, but also most likely you're going to buy a car or an SUV or some sort of vehicle. And auto sales hit 16.3 million North America SAR last month, up from 7.7 million in April. We have seen a massive V in auto sales. So housing and auto, really great trajectories. I want us to continue to see rates stay low. And again, we will need some more fiscal stimulus to help propel these parts of the economy to do better and to continue the momentum. But I do believe there is a lot of momentum, even if we don't get additional stimulus until maybe 1Q of 2021. The other piece of the economy that is doing quite well is manufacturing. If you look at PMIs, you look at ISMs, you look at new orders across the board, the numbers are the best in 2 to 3 years. So this is also very important because there's also a multiplier effect. For every 1 job in manufacturing that is created, 7.7 jobs are created around it. So that's why, again, housing and manufacturing are super, super important. And I'm not dismissing how terrible the travel, leisure, hospitality industries are, what they're going through, but it is, there are some parts of the economy that are doing better, and they're much bigger in terms of a percentage of GDP or overall GDP. So one last number, Matt, is the total global fiscal and monetary policy, 90 trillion. If you look at the US fiscal and monetary, it's 44%. If you add the two together, 44% of US GDP. Back in 2008, last time we had a, kind of a pandemic of some sort, or a, some obviously the financial tragedy back in 2008, you had only about 5% of US GDP was fiscal and monetary policy. So you see how extreme it has become, and the liquidity is something not to be fought. And that is why we are seeing the markets at almost new highs, right? I mean, today is a little bit different, but we're seeing some nice momentum in the equity markets, and I think a lot of that is because of the liquidity.
Absolutely, and as we've talked internally, there's still plenty of liquidity on the sideline in money markets. Investors still have been in disbelief for a large part of the gain since March. So there is potentially further fuel to that fire, if you will. Jillian, I'll turn back to you. In terms of the stimulus, are you seeing or hearing anything that will direct this to, businesses, individual income relief or replacement? Any direction that you see in terms of where the stimulus may be directed towards?
Yeah, I mean, I'll start by sharing that Vanguard has been pretty heavily involved in Washington in the negotiations toward another stimulus package for really since the passage of the CARES Act. On behalf of our clients, just recognizing that we do need another robust influx of government money into the economy. So start with that starting point and say that, the truth is, from the on-the-ground perspective, talking with members of Congress who are going to be integral to coming to some sort of an agreement. I don't think we were surprised it didn't come together pre-election. And I think we're really encouraged that there seems to be an interest in coming together in the lame duck potentially. But the items that are really outstanding and started out controversial have not improved at all. So you asked, kind of what is expected in the package. And I think we would widely expect to see some sort of PPP refill or extension. Unemployment insurance, absolutely, but at a much lower dollar amount, maybe in the 300 range rather than the 600 range from earlier this spring and summer. Direct payments to individuals, I think, is highly likely. It's something that, there's a lot of bipartisan appeal for taking that approach to put money in investors and Americans' pockets immediately. But the sticking points remain, and liability protection in particular, throughout the negotiations between Pelosi and Mnuchin for, the months leading up to the election that were very, news noteworthy, but really didn't seem to get anywhere. They never even got to discussing really how to approach liability protections in a way that would satisfy both parties. They were so caught up in the top line number, which remains, of course, a huge issue, and in state and local aid, which, as you know, we've all seen plenty of the comments coming out of many Senate Republicans and also President Trump at the debates a few weeks ago about, just bailing out blue states and how that's just so politically unappealing to many Republican or conservative members of Congress. So I say all that not to throw cold water on the ability for them to reach an agreement in the lame duck, but I think, as Stephanie said, it might be more likely that this gets done in Q1. But regardless, if we're dealing with divided government, I think that the hopes of some grand, $2+ trillion package, in our perspective, are not real. So we would put kind of as a floor about a $500 billion package, which is, of course, what Leader McConnell did push through or attempt to push through the Senate, months ago and weeks ago, and the ceiling really being $1 trillion. And what falls within that are a lot of the things I outlined, and also just further health relief. So whether that is testing or supplies, and some of those pieces could be non-controversial enough to potentially ride on to a government funding bill that will have to pass around December 11th later this year. It's a must-pass vehicle, so it's really enticing to try and throw some stuff on and clear the decks and get it out of the way. But I don't think we give it above a 50% chance that the larger, more meaningful 500 billion plus part of any sort of deal can be agreed upon this year, probably looking at within the Biden administration.
Got it. And you hit one of the questions that just came in related to a grand bargain about raising spending and keeping the corporate tax cuts permanent. So it sounds like that the likelihood that you see that grand bargain unfolding pretty low.
I think so. I would never want to rule out anything. And I think certainly those conversations will happen. And there are a lot of good reasons why it should probably be considered. But particularly when you mention making permanent some of the TCJA provisions that otherwise expire in 2025, I don't see any incentive for the Biden administration or the Democratic-controlled House to care to play ball on that.
Got it. Okay. We'll pivot for a second and look at some of the non-traditional markets. Nick, your area and focus is a little bit less on traditional stock and bonds. Where else are you looking outside of traditional markets for growth, because equity is, again, as we mentioned earlier, near all-time highs. Interest rates are starting to rise, so bonds are being challenged here. What's attractive to you outside of, again, traditional markets these days?
Yeah, so what we see if we look at capital market assumptions going forward and the returns for equities that are expected by, say BlackRock published their capital markets assumptions quite widely. There's an expectation the next 5 years for equities is, maybe 5% per year. Bonds more on the government side is 0. So a 60-40 portfolio, which is traditionally what investors are investing in with a well-diversified balanced portfolio, looking at about 4.3%. That's well below people's expectation, not only of what their portfolio should deliver, but what they've experienced in the last 10 years of a bull market. So, for us, we see a lot of people looking at different areas to access growth. And it's no surprise that they're looking more to the private market. So if we look at the stock market itself over the last 20 years, the amount of companies that are public that are available to buy and sell over the markets is about halved. So right now, if you're an investor looking for growth opportunities outside of that, you've really got to look to the private market. So things like private equity, private real estate, for growth. And the interesting part about these companies are they're companies that they're in that high growth phase before they hit the market. So think of angel investing, venture capital, growth equity, and then your bigger leverage buyout type situations where these managers are able to add additional return or additional alpha over and above the market by being more liquid in the investments that they make. So there is a trade-off between liquidity and potential to generate additional growth, but it's certainly an area that's gaining more traction. It's gaining more traction because even the SEC is talking about reducing the barriers to entry and democratizing the financial services industry. So we're seeing a lot more offerings come down market to the ultra high net worth or high net worth market itself. So these are things, this is a massive trend within the financial services industry that is going to unlock those growth opportunities and potentials. But we are seeing, from the people we are talking to, that they are very much looking not only to private equity for growth, but real estate as well. And I'll piggyback on this as well. The dislocation that we've seen in markets has really brought hedge funds back into the forefront of people's minds. Global macro hedge funds, which are able to trade these more macro themes that impact markets, have performed quite well for the first time in 10 years, and they've come back to the fray when it comes to people's attention. And the final thing I would say is, we've hit the 0 interest rate bound again here in the US. So people are looking for additional sources of yield. So I would say, private credit, where there's direct lending strategies where buyers and sellers are coming to market together and bypassing that typical syndicated bank market, is offering some really attractive yields to investors as well. So there is a lot of opportunity out there, just looking beyond those traditional sources of either yield or growth.
Yeah, and you may have to start.
Matt.
Yeah.
Could I build on some points that Nick was making related to private equity?
Sure, please.
I think it's worth watching closely the nominations process for the SEC in particular, and even in a divided government situation, the types of nominees that will be confirmable and then sent to really establish and implement the SEC's agenda could have a pretty dramatic impact on what Nick was alluding to, which is just this new enthusiasm for democratizing access to private markets in particular. And as you know, the SEC has sought to advance some rulemaking in this space, expanding the accredited investor definition and finding other ways to make that more palatable to more mainstream investors. But we see that as something largely opposed by many progressive Democrats. And I think depending on who becomes the new chairperson of the SEC, the agenda on that particular item could look pretty different. And related, DOL, as you know, had a rule proposal and some guidance related to private equity investing within the past year that really tried to encourage the same, really try and make it easier to allow private equity investing within institutional retirement plans. And under a Democratic administration, really regardless of Senate control, that could look very different as well.
Yeah, and as we kind of noted at the beginning of this, there are still plenty of things up in the air that will have far-reaching impacts as far as what the landscape in private equity and in private investments will be going forward. Let me turn back to policy briefly. If we go back to a year ago from today, the focus for most investors was trade policy and really the trade wars that were going on with primarily the United States and China. Jillien, I think it's safe to say the expectation for trade policy between the Biden administration and China, as well as other countries, is not going to be as tough as the Trump administration was, or use different tools other than tariffs. What's the expectation for trade policies for the Biden administration?
Great question. I think certainly we anticipate a different approach and a different style to international relationships generally, and specifically to some trade agreements and trade partner relationships. So, expect to see the use of more multilateral relationships and re-entering many of the multilateral groups that Trump has pulled us either out of completely or slightly away from. So that would be the biggest high level differentiator. But I will say that the point of China in particular does not necessarily cease up in a Biden administration. Anti-China rhetoric in general has become just a very popular direction for both parties. And it's something that has bipartisan appeal, frankly. And there are many pieces of outstanding legislation in Congress that, while they have not yet fully advanced, don't have any real impediments or roadblocks to advancing once, maybe some deem the time right. So we think that the Biden administration will continue to keep up a lot of pressure on our relationships with China. And as you said, that may look different. We expect to see continued efforts to decrease the ability to invest in China, from an investment perspective in particular, and whether that is US dollars going into investments in Chinese companies that are listed in mainland China, perhaps, or whether that is the ability for Chinese companies themselves to list on US exchanges. So as you may know, there's a major piece of legislation that seeks to tackle this that would remove them if they don't comply with certain audit requirements. So I think we expect that continue to be a really ripe space.
Got it. And again, it was quite market moving, both with respect to China, but also Europe as well. Stephanie, when you are thinking about what companies, what industries, sectors you're looking at, how does a change to trade policy, differences in currency expectations going forward, how does this impact or not impact what you're looking for and looking to buy?
I think the easiest answer is, if Biden wins with a mixed Congress, I think you have a weak dollar. And a weak dollar is very favorable for US multinational companies, and to Nick's point, maybe even to emerging markets and international companies themselves, right? But I'm a US investor, and I think that with most of the companies in the S&P 500 having 60 to 70% of their revenues tied outside of the US, they certainly would benefit from a weaker dollar. I come back to some of the themes that I talked about initially in terms of housing, and I think I definitely want to still be involved in housing. That said, that sector is up remarkably from the lows. So you want to definitely pick and choose where you want to be involved. But when I hear companies, my home builders, for example, talk about double-digit order rates in the starter homes, for example, I think that is very encouraging. And it's not just COVID. It's not just people leaving the cities to come to the suburbs. Yes, that's certainly a theme. But it's also millennials, and that's what they're telling us. It's the millennials are starting to buy because rates are so low. And while home prices are going higher, the trade-off on lower interest rates is certainly helping. On auto, I still think there's a lot of skepticism on auto. As I mentioned, in terms of the recovery in North America SAR has been remarkable, but China is actually now up year over year in auto sales. So that is certainly something that you want to keep in mind, and I think that is certainly something that will continue. Again, as you see this housing boom, and as I mentioned before, you sort of need kind of a car or some sort of transportation, and I think people are a little wary of getting into public transportation, right, until we get that vaccine. So that's certainly something. Manufacturing, I mean, there's so many parts of manufacturing: agriculture, construction, non-resi and resi construction, automation, process automation is certainly something that is certainly interesting as well to me. So there are a lot of areas within manufacturing that I think will continue to do well. And oh, by the way, consumer, as I mentioned before, the consumer while sentiment has stayed remarkably strong, Nick made the point earlier, savings rates. Savings rates right now for the consumer are still 14%. The average is 5%. If you were to go back down from 14% to 5%, which is, again, the historical rate of savings for the consumer, that's $1 trillion worth of spending that would have to have done into the economy. So that's remarkable too, right? So you have all these kind of numbers, and I do think that with obviously unemployment is still high, but at least we're making some headway in terms of initial claims and non-farm payrolls and that sort of thing. And if you look at any of the manufacturing data that I do, the employment data within the manufacturing is also showing certainly a recovery as well. So I feel pretty good about the consumer, watching obviously fiscal and all kinds of things that need to happen to continue the momentum. But I think these are places that you want to have substantial investments in. And then I would just simply say, last but not least, those are kind of more the cyclical side of the markets. On the more traditional, I know technology is certainly seeing a sell-off in the last couple of days, but I do believe very, very strongly that total addressable markets matter. You have to have growth, right? And these companies, technology in general, have growth. You know, is it AI? Is it SaaS cloud? Is it e-commerce, retail e-commerce? All of these kinds of areas, data center, 5G. I mean, I can list a whole like laundry list for you, but I think you want to actually have exposure to some of these companies. And while they are overcrowded and overloved at this point, this is where you make your shopping list and you say, okay, if it gets to this price, this is where I feel really good about the valuation, the growth rate potential, the margin upside, the operating leverage. And so I have been saying barbell for a long time. And I truly believe that, because you do want to have a diversified portfolio overall in general.
Perfect. And part of that diversified portfolio, we'll pivot into policy and markets here with healthcare. This has obviously been front and center all year long because of COVID, but also it was a sticking point with a lot of Democrats, and even just, I'd say roughly 20, 30 minutes before this webinar started, President-elect Biden and Kamala Harris were on TV talking about their healthcare plan, because currently the Affordable Care Act is with the Supreme Court. Biden has talked about his Biden Care Act as well. Jillien, when you fast forward 12 months from now, what does the landscape for healthcare look like from your perspective?
I will say that probably there will be some twists and turns between now and 12 months, but I think we anticipate it will largely look the same as it does now. I don't expect that there will be any opportunity, frankly, for Democrats to aggressively or meaningfully expand upon the Affordable Care Act, as though I know they would have hoped to in a unified government scenario. I do think that ACA will stand and will be, kind of the rule of the road for the foreseeable future.
Perfect. And Stephanie, again, going back to markets recently, in the last week, healthcare has produced quite attractive returns, again, largely based on election outcomes and a little bit of a relief rally from the lack of a blue wave. Are there any industries or subsectors within healthcare that seem particularly attractive to you going forward?
It's interesting. Healthcare in the S&P 500 is about 14.5% weighting. So it's pretty substantial. You have to have some sort of exposure, right? As you very well know. I've been a big fan of the HMOs, and because I do think the public option is not going to happen. I think that Biden and Harris will focus more on ACA and getting that, whatever right means, when how they say it, and getting it just easier and more efficient. I think that's what they're going to spend their time on, and I think that the public companies are going to do just fine in that regard. I do think that COVID will continue to lead to more investments in biotech companies. And so I think you can have exposure to some of the biotech companies as well. I'm a huge fan of animal health because I am a dog lover and a cat lover and everything else. And I heard a dog in the background earlier, but so somebody else is obviously as well. But I do believe that you're in early innings in terms of animal health in general. And there's so few companies that to get exposure there. And so I really feel like that is absolutely something that you want to get behind. I think the one area that might struggle, Matt, is pharmaceuticals. I do think both parties really want to put price controls in place in some way, shape, or form. Do I think it happens? No. But I do think the rhetoric kind of gets turned up a notch, and that's going to hurt your multiple. So while these companies have wonderful yields, and we're all like starving for yield, so I get it. Great balance sheets, great cash flow. Just know that if you own these companies, you probably have a bit of a headwind in terms of multiple expansion and then huge outperformance on a relative basis. But I think you pick your spots there as well, some high quality companies, and I think you'll do just fine over the long haul.
And similar to drug pricing, I think one of the other bipartisan segments or views is tech regulation as well. Nick, I'll turn to you because correct me if I'm wrong. I think you're based in the Bay Area, so you may know a few more people in tech than the rest of us. But any sense on tech regulation and the impact that this is having on equity markets in general?
So I think, it's a great question because it's part of the outperformance. The FANGs M has been strong all year, obviously as part of the work from home overriding theme, but, connecting us digitally and that acceleration that we saw. I think it was the CEO of Microsoft came out and said in the first, 2 months of the pandemic, we had accelerated technology advancement by 2 years. So this is an area that's growing larger and larger, and people are more concerned about it, especially when, we had the 2016 election where there was concern around Facebook and Twitter and the outcomes there really impacting the election and some bad actors taking advantage of that. So regulation of the tech industry and the breakup of big tech has been something that the Democrats have championed all the way through the election. I think the result cheered that, and I think people are very much happy that probably won't proceed, and we won't get any massive reform there anytime soon. So I think from just looking at the policies that that each side has talked about, it's unlikely that we'll see any real regulation. We might get regulation light, if anything, in terms of the tech industry.
And that regulation light, again, that's somewhat been the theme of the day with a divided Congress. No one party is going to push extremes on any specific policy. So we'll wrap up.
Right. Yeah, there's between healthcare, technology, infrastructure, industrials, and materials, nothing's really going to move. And I think Stephanie said this at the start, the market likes gridlock. And, if we look at the way the election panned out, and people are saying, well, this isn't reflective of our nation. This is absolutely reflective of our nation because we've had more people vote in this election than ever before. So the fact that we have a split Congress is the fact that that's the way that the country wanted it. And quite frankly, I think we got what we voted for. It was a referendum on Trump. People like his policies. They don't like him. They like Biden's policies. Or they like Biden. They don't like his policies. So, the lesser of two evils, which is what the Vice President Biden and President-elect now brings to bear, is something the markets have craving. We tried something different for 4 years. It would say from the election results that didn't work, and we're going to go back to something that we're a little bit more familiar with, which is gridlock.
Absolutely. Jillien, I'll turn to you for any last words as well before we wrap up.
Yeah, I think when we've talked a lot about gridlock, I think it's important to remember that could very well be 2 years worth of gridlock and then 2 years of potentially unified government. The Senate races that are up in 2 years largely put many Republicans having to defend those seats much as they have this time. And it looks like this time they may have been successful in doing so. But in the event that in 2 years, the dynamics in this country have shifted, and those races in particular in states on the ground have shifted, we could find ourselves talking about many of these things that we've said are off the table could suddenly be back in the spotlight.
And after this election season, it's hard to think of the next election season. I can tell you I'm exhausted of the political news that has been constant for the last 6 months. So hopefully we don't turn to that next election too soon. But last but not least, Stephanie, any last words here before we sign off?
Yeah, I just simply want to remind everyone that stocks follow earnings, and earnings are actually coming in much better than expected. So for the most part, the majority of the S&P 500 companies have reported, and 84% are beating on the bottom line, on the earnings line, and 75% are beating on the top line. And I will just say, Matt, you pointed this out to me actually earlier this week, that expectations for earnings this quarter have actually been rising. So the expectations were much higher. There was a much higher bar than last quarter, where we had no idea, right? It was we didn't even have estimates. We had no idea what to model. So I feel really good that the economy is on the right track in terms of recovering, and that's going to lead to better profits and better earnings. And I think that's still very much unappreciated in the marketplace. We may not get multiple expansion next year, but I do think there's a chance, there's a very good chance that we could see 30% earnings growth year over year next year to this year. And that will be very good and very healthy for stocks. So stay diversified. And I think you don't want to have all your eggs in one basket on technology. You don't want to have all your eggs in one basket on cyclicals. I think you want to definitely have a blend. And I just leave again with the barbell approach. I think that works well over the long term.
Perfect. We thank all of you, Stephanie, Nick, Jillian. Thank you so much for sharing your thoughts, your views into both Washington as well as how this will interact with markets. So thank you, everybody. And again, we thank you, everybody, for participating and sending questions in. Have a great day.